4 p.m. Central African time as we turn our focus now on Nigeria, where the country's Federal Inland Revenue Service has directed banks, stockbrokers, as well as other financial institutions to deduct a 10% withholding tax on interest earned from investments in short-term securities. Now, the new directive requires tax to be deducted at the point of payment on instruments such as treasury bills, corporate bonds, promissory notes, as well as bills of exchange. Prior to this directive, short-term bills were tax-exempt, and this was done in order to boost returns for investors. Helping us understand the rationale behind this new directive is Dennis O'Shea, a certified financial modeling and valuation analyst. Good to have you with us once again. Welcome.
Thank you for having me, Tammy. It's always a pleasure to be on the program.
So let's start with an understanding of what the rationale behind the Nigerian government imposing this 10% withholding tax on interest.
The rationale, definitely the answer is going to be revenue generation, because now the country is looking super well. If you remember the last time we spoke, I gave you that there are cycles that are in the country that you must look at economically, and now the government, they know that, and they're taking advantage of that cycle, and Nigeria is in a very good cycle right now economically, so they're taking advantage of that to boost revenue generation for the country, which is one of the primary rationale to broaden the tax base and increase non-oil revenue for the country.
And what impact is this likely to have, specifically on domestic investors and the short-term securities market where this directive is targeted?
Yeah, for me, it's a double-edged sword, right? As much as they're trying to generate revenue for the country, at the same time, it's going to be an issue also for the country, because now you are not friendly to investors who want to take advantage of the economy's prosperity at this cycle and then get short-term revenue before the next cycle starts in January. So there are people that are taking advantage of the October, November, December short-term cycle to take a lot of the profits from their short-term investments. And before the next cycle, they don't know what policy is going to be implemented. So now they're trying to reduce the amount of investment that will come in. But it's also good for the government, because the government is trying to reduce risk, because anytime the government tries to reduce short-term investment and then prioritize long-term investment, it reduces the risk that the government carries on. So it's a double-edged sword.
And it is all about risk, Dennis, as you say. Yes, indeed, this is a measure to try and generate revenue. But could there have been other methods or perhaps other strategies that the federal government could have put in place in order to try and boost revenue? And I ask this because does this move outweigh the risks of the possible lack of investment in short-term instruments because of these changes?
Yes, you're very correct. Like we've had these conversations before, the issue that most African economies have and most African nations have is that there is no long-term planning, economic planning, and we see that a lot. With, for example, recently China is celebrating a 15th year of implementing 5-year consecutive terms. That is 75 years of planning every 5 years. And with that, they have foresight, they have insight, they have hindsight, they have several other models that they can run economically. And we don't see that in Africa. And this is one of the things that will happen to African countries if we don't have economic models that are being projected just the way we see China is. So the earlier they can implement these models that will project into the future, the better they can accommodate either short-term or long-term investors. Because it doesn't really make sense. Also, they can explore other forms of revenue generation. Oil is more than enough. Nigeria has one of the largest reserves of oil in the world. Some are comparing it to Saudi Arabia and Venezuela, but they are not confirmed yet. But it is believed that that can cover more than enough. So, yeah.
All right, Dennis O'Shea, thank you. Thank you very much for that update. Some sweeping developments there as far as the withholding of tax on short-term securities. Thank you, Dennis.
Having me, well appreciated.
Very much so. That's Dennis O'Shea, is a certified financial model and valuation analyst.